China's economy met our expectations in the September quarter. Year-to-date growth in GDP edging down from 5.3% to 5.2%, a touch above the 5% target for 2025. Quarter-on-quarter, growth also showed persistence, though in 2025 it has averaged 4.5% annualized, not 5%. The partial data for September again made clear production and trade have driven these gains. In September, annual growth in industrial production materially beat market expectations, accelerating to 6.5%, as exports recorded an 8.3% gain. Growth in fixed asset investment turned negative, however. By subsector, property investment remained the most significant drag, but investment in key high-tech subsectors also retreated after surging through 2021 to 2024. Automobile, transport, and utility-related capacity expansion is also now occurring at a much slower pace, providing less of an offset to the deterioration being experienced in the aforementioned subsectors. The pullback seen in China's key high-tech subsectors was inevitable, given authorities' growing focus on return on investment and sustainable profit margins. It's a sign of growing maturity and strength for the economy overall. However, the timing of the slowdown risks a material step down in GDP growth in 2026 if property investment and household consumption do not pick up quickly. It's not surprising then that the initial communications from the just completed Central Committee Plenum on the 5-year plan to 2030 has strong focus on the consumer and domestic investment. Specifically, press reports reference increased efforts to guarantee and improve people's livelihoods, and to improve the social security system. The call to promote the high-quality development of the real estate sector arguably highlights that households not only need more quality housing and community infrastructure to build lives in, but also the ability to accrue wealth sustainably throughout their lifetime. From the telegraphed outcomes of the plenum, it was also clear the government intends to continue pushing forward with economic and technological development, looking to become self-reliant, but also to be able to continue growing their share of global markets, particularly in high-tech goods. Achieving this aim will further boost trade income over time. However, at this juncture, it is not necessarily the quantum of additional income that is most important, but rather its breadth and its distribution. In aggregate, Chinese households have excess cash and high savings rates, but the hit to wealth experienced because of the substantial decline in house prices in recent years and a poorly performing equity market are restraining discretionary spending. Concerns over employment and wage prospects have also been a material hindrance to the average household. To change this narrative, households must have confidence in the outlook for wealth and the labour market, and believe that, where necessary, the government will support them. The full detail of the 5-year plan is unlikely to be received before March of next year. In our view, this will be too late for an uplift in stimulus if authorities desire to achieve a similar growth rate in 2026 as in 2025. If we do not see a meaningful lift in direct support for the consumer and an end to housing's price and activity declines soon, Chinese GDP growth is likely to be nearer 4% in 2026 than the 4.5% annualized pace of recent quarters, let alone the 5% full-year outcome expected for 2025. Note, the Chinese consumer doesn't have to achieve a growth reset on their own, but they are integral to it. If local governments become confident in the outlook, they will step in to increase investment in their regions, taking advantage of the reduced cost of funds and capital now on offer. Progress is also recursive, consumption incentivizing investment, and capital expenditure begetting additional jobs, income, and, in time, household spending. The primary risks to China's economic outlook are therefore not outside its borders, but within. Whether China can achieve its ambitions for development a decade from today may well depend on their willingness to usher in active support for consumer sentiment and wealth in the next few months. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.